Welcome back. You're listening Hawaii Money Resource. My name is Marko Miushkovic, Senior Partner at Wealth Strategy Partners, also Certified Exit Planner. Today we have a Business Exit Planning edition of Hawaii Money Resource, and we have our brain trust or brain power or Business Exit Planning Advisory Board with me in the studio. Ethan Lee from Pacific Business Valuation, Charles Zhao from ECA LLP, CPA firm, and we have a Scott Settle from Settlemeyer Attorneys firm. And myself, of course, exit planner, quarterback for you. If you have any questions, because we have all this brain power right here that can answer all of your questions, and you don't know what to do, you're kind of stuck with your business, you want to get out, maybe you're getting burned out, maybe you want to transfer internally to your management or your family members, but you don't know how, give us a call, 695-2102, 695-2102. It's very important for every professional in our Exit Planning Advisory Board to take a look at your situation and give you our input. Before the break, we were talking about buy and sell agreements, and we can talk about buy and sell agreements pretty much the whole show and probably not even cover everything, right? But I would like to take it a little bit further, and I would like to talk about, okay, I'm running the business, I have all these processes and procedures, and I have all these brand names, and I have all these proprietary tools in my business. What should I do? How can I extract that out of the business, put it somewhere else, and maybe continue past the point of transferring that business or selling that business? So Charles, let's start with you. What do you think about that?
Marco, we think it's a good planning opportunity. We believe that the different types, having our clients understand what makes them money, both regard to their actual active trader business as well as their intangible assets, things like their trade name, their formulas, and things like that. Understanding the difference and the value that they bring can create some tax opportunities. How you dispose of those assets, either the business and or the goodwill, have different tax treatment.
What do you think about from your professional standpoint, like when you're dealing with the businesses and business owners, how many of them they actually go their route?
Marco, it's probably a minority of our businesses, probably less than a third of our clients look at their business and try to bifurcate their assets or their streams of income into its respective parts. For those that do, we find that if they're aggressive and they're able to quantify and bundle those assets in different ways, there's opportunities to move the assets into different entities, into different ownership structures, even into different states that have possibly the advantage of a lower tax rate environment.
What do you think about that, Scott, from the legal or from your point of view?
I think it's really important for owners to understand what's the composition of their business, not just the actual services or the goods they manufacture, but their name, their value, and their goodwill, their reputation, and any intellectual property. And some of it is comes to mind very easily, like if you have a patent or you have a trademark or a copyright or something like that. But also just if you have a secret way or a special way of doing things, you can put value to that and speak with your accountant and your business value advisor on how to do that. And typically, when you go to sell the business, the buyer is going to pay you a price based on your revenue, your income or your revenue, and doesn't really care that much about how you want to classify what they're paying for. You typically have some flexibility as a seller in classifying, and that's when it's really important to talk to Charles about, okay, if I sell an inventory or a hard asset, what's the tax effect of that versus if I'm selling an intellectual property or goodwill or something intangible? Is there a benefit to classifying a portion of the purchase price to pay that and save on some taxes?
So do you, Charles, going back to you again, do you see this additional planning opportunity, maybe even while the business is still operating and maybe not planning to sell yet?
Marco, the best time to structure things is before you need to do it, before you plan to do it. So,
and why is that?
Well, two things. If there's a business purpose, ideally you're doing things for business purposes, not just for tax savings. And so doing it ahead of time provides the support. That's why you're doing it. So that's the one. The other is doing it at a time when you've got a clear mind and you've got time to plan for it, you can actually, once you split up the business into its component parts, you're actually able to build value. You can make certain business decisions to grow and support the different component parts depending on how you want to exit to maximize the tax savings.
Perfect. And then, of course, when it comes to valuation of the business, Ethan, how do you look at it in if the business owner is kind of broke apart the different pieces of the business, and let's say the goodwill, recipes, or whatever they have is in a separate corporation, and maybe even in a different state, how do you approach that valuation?
Well, I think that's why we get engaged, is to help the owners break that apart, because oftentimes they don't know how to do that and what the intangible assets are worth. And so with goodwill, there's generally two types. There's what's called enterprise goodwill that stays with the business and would transfer with the business when it's sold. And there's also personal goodwill, which attaches to maybe the owner or a key employee. And that, personal goodwill can be reputation, it can be knowledge, it can be relationships, and those things can be transferred if you plan, and it takes time. And so 3 to 5 years usually, especially for a professional service practice where the owner has all the relationships, those can be transferred over time, as well as some of the knowledge to the person coming in. So in order to maximize full value for the business, planning needs to take place.
I know it's more complicated than it sounds, but Charles, how do you extract that value, let's say, from the current corporation, and after Ethan appraises, say Ethan said the value of this goodwill is like X amount of dollars, how do you extract that and put it somewhere else? Because there is already a dollar value assigned to it.
Yeah, that's a good question, Marco. It depends on the business and the type of industry that they're in. I can share an example of a company here that they feel that they have a unique way of training their employees and their contractors and a way of marketing. So what they've done is they've actually built the documentation around that, both with regard to how they train their people and also how they go about their marketing and execute their business. And so what they did is they wrote the programs partly in the company for the ones that stayed there, but they also had some work that was actually done outside the company. So we took the work that was not the marketing piece especially and moved that to a company that was based in Nevada. It just happened to be. And by building the structure, formalizing the structure there, we're able to build value that way.
So just let me clarify. So if you want to do something like that, you want to do it probably from the get-go, set it up to be owned by the separate entity from the scratch, not needed to extract it later on from the original company, because there is a value transfer, right? So
That's right.
And you probably need to pay for that somehow, some way.
Yes. Everything needs to be at arm's length, at fair value. So the sooner you build it and document it before it takes on a life of its own and you begin to monetize that value, it's better to do it that way.
What do you think about that, Scott?
I think that's great. That's great planning, and that's really in-depth planning, and that's, I think, shows you the value of thinking ahead and talking to somebody like Charles, particularly when you have a business that has various component parts.
Does it need to be, Ethan, maybe question for you or question for Charles or Scott, does it need to be in kind of like in the same domain what your primary business is, or does not? Like, sounds like in this case what you said, Charles, this was completely something different. It was a marketing, it was a training, not even the primary business that they were doing in their original company, right?
And Marco, it's a service business, and so the training they do, it does certainly perfect their key asset, which is their people. But again, it was separate and apart from the business, the actual execution of the service. Yes.
Why did they do it in Nevada versus Hawaii?
A couple of reasons. Nevada has clearly no state income tax, so there was an advantage there. And the other was, in their view, in talking to their attorney, they believe that there was some liability protection afforded them in the Nevada setting.
Okay. Ethan, when they are praising the business and they have a separate entity that owns this, do you appraise the business in whole or separate it? you separate each entity and put the value on each entity.
Yeah, so I guess it would depend on the purpose of the valuation, but yeah, usually if it's in a separate entity, that's one business that would be valued, and the value is measured by the cash flow that it would be expected to produce.
When it comes to the sale, let's say down the road, and you get into the point, okay, you have a company A in Nevada, for example, that owns all the trade secrets and trademarks and everything, and now you have a corporation B that is, instead of Hawaii, that is a primary revenue generator. From your experience, what you find out, will the potential buyer, be okay by just buying the one that is revenue generating versus both? You see what I'm saying? Like, because a lot of time business owner would like to retain the one that is just collecting the royalties and fees from the original company versus selling them both. Because in the one that is generating royalties and fees, they don't need to do anything.
Yeah, so I think if the intellectual property that might be held in a separate entity is key to the operations of the operating entity, then I think it would probably be wise to sell both of them, because if a buyer is just going to be buying one entity but doesn't have the benefit of any of the goodwill or intellectual property that's held in a separate entity, the business might not be
appealing that much.
Yeah, exactly.
Okay, good. What do you think about that, Charles?
Yeah, Marco, the advantage to the seller of having it split provides them an opportunity to retain some value and possibly use it and to pass it on to their children, to their heirs. But I agree with Ethan's analysis that max value would be to sell it together, and many of our clients will do that. It just provides more options for them.
Is there any particular way how you would like to structure, how you can structure that? Maybe a question for you, Scott. How you can structure it so you can still retain that piece of the business and continue collecting the fees and royalties? Is there any way that people should be aware of it? I mean, of course they need to come and see us first, but is there any way how you can do it so it's still sellable and you can still retain it?
Sure, I think maybe a situation comes to mind where the operating company is sold along with a limited term license to use the intellectual property for a period of time to allow the buyer of the business to get the benefit of their bargain, to be able to operate the business properly and an ability to use the intellectual property for a period of time at a known cost, and then perhaps that intellectual property is so valuable that over time that license fee can go up, so that the original seller can still retain some value long term. And really, that's a question really for Ethan to figure out how to value that to the seller. But I think that's one way to do it is with some licensing arrangement.
Perfect. Why don't we take our last break for today? We have a business exit planning edition of Hawaii Money Resource. My name is Marko Miushkovic. We have Ethan Lee, Pacific Business Valuation. You can find him online, pacificbusinessvaluation.com or 687-0309. We have a Charles Zhao. Charles, what's the main line?
It's 533-4244.
And then we have a Scott Settle from Settlemeyer Law Firm. The best number to reach Scott is 540-2400, 540-2400. If you're a business owner and you're stuck, you're looking to get out of the business, or just plan strategically with your current business, give us a call. We have all brain power right here on our disposal, 695-2102, 695-2102. My name is Marko Miushkovic. Stay tuned. We'll be right back.